The Bank of Canada sees some growing vulnerability in our financial system, and that vulnerability has a face. That of the Canadian homeowner. Some have already been hit with sharp spike in their mortgage payments, and others will soon join them as they renew their loans. Jeannie Lee is here with that story. Jeannie, what more does the bank say about this very stressed out group of folks?
Well, stressed out because they are either paying or looking at paying between 20 and 40% more on their mortgages when they have to renew. Now, if they can't afford to pay, of course, they can also stretch out their amortizations, but that just kicks the can down the road by sometimes decades. So that is not a great solution either. Now, all of this, by the way, a result of the bank's own aggressive attack on inflation. We know it famously raised interest rates 8 times in a row, starting about 14 months ago. So here's Senior Deputy Governor of the Bank of Canada, Carolyn Rogers. Have a listen.
Higher debt servicing costs are stretching budgets and reducing borrowers' financial flexibility. About 1/3 of households have seen their mortgage payments increase since February 2022, just before the bank started raising the policy interest rate. Lenders and regulators are taking steps to provide borrowers with options for managing higher payments, such as extending amortizations. However, as borrowers make use of these options, they may have less capacity to absorb future shocks.
Future shocks, meaning if anything else goes wrong, say if housing prices were to start going down again like they were for a while, if the job market should stumble, if there are massive layoffs with the banks possibly getting tougher with lending, and an economic slowdown, that's always a possibility. That just means that people who are more on the edge financially because of these higher borrowing costs will have very little safety net to help them absorb the shock and also avoid defaulting on their mortgages. And enough people default on their mortgages, well, lenders would obviously be left holding the bag and suffering big losses. So you see why this is seen as a vulnerability in the system, Hannah.
Yeah, absolutely. Any way to predict how rough it could get?
Well, we should say that the bank was always stressing that it's not predicting what will happen. It's just looking at the conditions that are existing now and saying what could happen, given various conditions. So here's what it is, sort of connecting the dots and seeing happening. Now, variable rate mortgage borrowers have either paid more, as I said, 20 to 40% more, or they've stretched out their loans. Then you have the time when it comes to renew those mortgages, and also fixed mortgage owners. When they're renewing, they will be facing that increase of as much as 40%. And the pain will spread month by month because more people are renewing their loans over the next 3.5 years, and the bank will be demanding higher payments. But again, conditions can change. These are dire scenarios, but at the same time, there is time to prepare. In many cases, people have 5-year mortgages, and so they have a little while to adjust. Rates could also go down again, which will give them a break. The other thing is the job market could stay strong. Their incomes can go up. That is possible, and maybe they can then adjust and pay down their principals as aggressively as possible. You know, this was something that people used to routinely do. When rates were 8-9% or even double digits, your goal was to pay down aggressively your mortgage versus just borrowing more and buying a bigger house because rates were so low. But that's, the olden times, I guess, and a lot of people really don't have that wiggle room, Hannah.
The olden days. Yes. Jeannie, thank you.
Okay.